Welcome to the Daybreak Asia podcast. I'm Doug Krisner. This week's key data point for markets is the U.S. CPI print. It happens on Wednesday, and in a moment we'll consider the outlook for U.S. inflation and how the Fed may respond with Lawrence Gillum. He is the chief fixed income strategist at LPL Financial. But first, economic stimulus in China. The country's top leaders recently signaled a more forceful approach in stimulus for the next year. Let's bring in Bloomberg's Jill Disis. She is our news desk editor joining from Hong Kong. Jill, I want to begin with the language that's being used by the Politburo. How would you characterize it, and is it different from what we've heard in the past?
Yes, Doug, I think this is absolutely significant. So what the Politburo did is so right now this is December. This is the time of the year when the Politburo, when a lot of other, of China's top leaders all get together and they start to talk about what policy is going to look like in 2025. So in a way, you can kind of think of this as sort of their forward guidance for next year, right? And what they've actually done here is they've said that they want to embrace what they call a moderately loose monetary policy in 2025. I mean, when it comes to China, everything is always just a little bit opaque, but this is pretty significant because it represents, for the first time in nearly 14 years, a shift from a more restrictive stance, what the Politburo has called, quote unquote, prudent. And this is all, kind of in response to some, concerns around, what's happening with, deflation or, sort of deflationary concerns in China, some of these price pressures, some concerns about economic growth, and then also what's happening with within the geopolitical sphere more broadly. And so what this tells us about how China is approaching policy in 2025 is that, this is an economy that for the last decade or so has been pretty restrictive about how much stimulus they actually roll out publicly. I mean, you go back to, you have to go back all the way to the Great Recession to actually find when they were introducing tons and tons of stimulus into the economy. They've been much more cautious recently, but it does seem like they're willing to make some changes here to actually get things growing in the economy again. So
it's curious. I mean, I'm wondering whether any of this is related to the possibility that Beijing is anticipating a much more adversarial relationship with the U.S. when Donald Trump takes office. Do you think that's a part of the story here?
It may be. I mean, look, China has dealt with Donald Trump before. I'm sure Xi Jinping is incredibly mindful of the relationship that these two had during the first Trump administration. Obviously, that's when the trade war was launched. You saw Donald Trump talk incredibly tough on China, and you saw quite a few, tariffs and other restrictions come into effect then that, quite frankly, just weren't, they were kept in place, right? I mean, the Biden administration actually kept in place and actually tightened a lot of restrictions. I mean, the U.S. Does have at this point, while these two economies, the world's largest, do depend on each other in many ways, there's still this adversarial relationship that's developing. And I'm sure Xi Jinping is thinking about the fact that during Donald Trump's latest presidential campaign, he was talking about imposing tariffs upwards of 60% on China for certain goods. I mean, this is not a relationship that seems to be improving in that sphere anytime soon. And so if you're China, you're sitting there thinking, well, you obviously want to keep things going. You want to, keep your economy growing, but you do have to hedge against the fact that the relationship with the U.S. doesn't really seem like it's going to be improving meaningfully anytime soon.
Particularly when you consider the fact that the export segment of the Chinese economy is really one of the strong points, right? I mean, you consider the fact that consumer sentiment, business sentiment even, has been very, very weak. The property market obviously has been a big culprit. But if we go back for a moment to the stimulus package, how much of this is being addressed to kind of target the property market, to target the equity market as a way of boosting sentiment?
Yes, Doug. Well, I think that at this point, certainly sentiment is an issue here. And, sometimes we've seen China kind of target these announcements to kind of get, the sort of the equities market moving again. Remember, China, it's a pretty closed off system. So you have quite a lot of retail investors, an overwhelming number of retail investors that actually invest in these onshore markets. And so gauging how exactly that market is performing is a pretty good barometer for what sentiment within the economy is looking like. So yeah, I mean, a lot of these measures are going to be targeted to that extent. We have seen quite a lot of stimulus measures this year that are sort of targeted at the property sector in particular. As you mentioned, Doug, I mean, that's been really sort of, this huge issue for China over the last several years, and kind of, stabilizing demand, kind of, getting this market, revived to some extent, sort of stemming a lot of the losses that are happening among a lot of these big property developers has been a really key concern for China. But of course, they want to do so in a way that doesn't add to, tremendous debt burdens, particularly for regional governments. And so this is all a big balancing act for China right now. And it looks like what they're doing is they're willing to sort of loosen policy a little bit in order to get things moving again. But they are still, using some level of restraint here as they kind of calculate how this needs to be done.
A moment ago, you were talking about this issue of deflation, and China really has been struggling with this for such a long time, at least more than 2 years, where factory gate inflation is concerned. We just had the latest PPI, CPI. What do we know about deflationary trends at the moment?
I mean, it's really, really rough. I think at this point, producer prices have fallen for 26 straight months.
Wow.
It's an unbelievable, eye-popping number there. When you look on the consumer side of things, you're also looking at, prices rising at their slowest pace in several months. Those prices have still been hovering around zero. So even when, these prices have been increasing month on month, you're barely eking out any gains here. And a lot of this does have to do with the fact that the average Chinese consumer just still isn't super confident in the economy. We have seen, China make some efforts to shore things up here. They've introduced, sort of smaller cash stimulus programs. There's one thing called like a cash for clunkers program, which essentially amounts to consumption vouchers that people can use to buy electronics and cars and stuff at discounts. But, obviously it does seem like there needs to be more done there. And so what the Politburo is promising is this idea of more forcefully lifting consumption. Maybe that means expanding some of those programs into 2025.
So before I let you go, I have to ask about this investigation that Beijing has opened into the chipmaker NVIDIA, obviously a big U.S. company, particularly when it comes to artificial intelligence. What do we know about this probe?
Yes. So what it appears to be is that, China's, it's their market regulations agency that's probing into NVIDIA, looking at, the acquisitions of some companies here. There's this acquisition of a company called Mellanox Technologies that Beijing approved 4 years ago on the condition that NVIDIA not discriminate against Chinese companies. It seems here that based on the fact that they're launching this investigation, maybe they think that things have happened otherwise here. The way that I would look at this, Doug, is you've got to put this in context of all of the, U.S.-led technology curbs against China over the past several years. The U.S. has really leaned on a lot of its allies, particularly in the West, to, stop selling technology to China or sort of bar the types of technology that they're selling to China. So the way that I would look at this probe into NVIDIA is this is kind of, China trying to fight back in some respect. I mean, how successful they ultimately are with, trying to sort of push back on the U.S. we'll have to ultimately see, because, again, as we've seen, the U.S. has been pretty forceful about launching all of these curbs against China, which have been pretty successful. I mean, we've, seen ways in which China has been prevented from using cutting-edge chips technology, for example. China obviously wants to see what kind of tools in its own toolkit it has to kind of stand up against the U.S. here.
Yeah, and just last week, I think the Biden administration expanded some of those curbs. The big question, I think, for Beijing is what will incoming President Donald Trump do? Jill, thank you so much for taking time to chat with us. Jill Disis there, Bloomberg News desk editor, joining from Hong Kong on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Stateside, markets are bracing for the latest reading on U.S. retail inflation. We've got that CPI data due on Wednesday. To help us look ahead, we're joined by Lawrence Gillum. He is the chief fixed income strategist at LPL Financial, joining from just outside Charlotte, North Carolina. Lawrence, thanks for being here. I think it's fair to say that CPI print is the critical data point before next week's Fed meeting.
That's absolutely right. First of all, thanks for having me on. Appreciate the the time. But yeah, this week it's all about CPI. Last week was labor market. Kind of came and went, but markets are really focused on CPI this week. Last big data point, as you pointed out, before the Fed meets next Wednesday.
Do you see anything possible that could remove the idea that we're not going to get a rate cut in December?
I think it would be tough. So right now, our expectation, market's expectation, is that the Fed is going to cut rates quarter of a point next Wednesday. I think it's going to take a reacceleration of inflationary pressures on this Wednesday to kind of maybe push back the rate cutting plans perhaps to till January. But with the labor market report that came in that showed the unemployment rate creeping up a little bit higher last week, I think that kind of gave the Fed all clear to cut next week.
So yields today were up right across the curve, not by a lot. I think the 10-year was up about 4 basis points in New York. So we've got a 10-year at 4.19%, a 2-year at 4.12%. Where do yields, in your view, go from here, Lawrence?
Yeah, so we've been in the camp where we're kind of in this trading range all year. So we've had a 375, 425 target for the 10-year this year. We're likely going to carry that into next year as well. Really, the curve is still pretty flat. You mentioned the gap between 2 years and 10 years is only about 7 basis points. So with the Fed cutting, we'll see the front end of the yield curve move lower. But I think really, the 10-year is kind of around where it should be, given what the markets are pricing in for the Fed rate cut cycle this time. So 425, we could possibly see 450 on an upside, but I think we're kind of where we are on a go-forward basis.
So we've been getting a little bit of detail in terms of economic policy from the incoming administration. Tariffs, obviously, one of the big issues for the market, and whether or not that necessarily leads to inflationary pressures. What's your view on what you're hearing from the incoming administration as it relates to inflation?
Yeah, so we are still waiting to hear more details. There's been a lot of kind of discussion or bluster out there, but until these tariffs are fully kind of announced and what's targeted, what's just talk, markets are kind of pushing that off into a 2025 type event. So it's still, I think, too early to try to figure that out into the current rate market. Right now, markets, like we just talked about, are really concerned about the inflationary data, the labor market data. 2025, I think, is going to be all about the fiscal support, the fiscal plans for this upcoming Trump administration. Tariffs, we've talked about tariffs with our advisors and clients here at LPL, and we've pointed out that it's not as cut and dry as tariffs always increase prices. They increase prices for sure for somebody, but it doesn't always necessarily translate into higher consumer prices. So, again, the devil is in the details, so to speak. So we're really going to have to see what is the result of all this tariff discussions.
Do you have a sense of the risk of a lot more Treasury supply coming to market, supply that would have to be digested in a way that may lead to higher yields?
Yeah, no, that's a great question. It's something that we're releasing our 2025 outlook piece tomorrow, in fact, and that is a big piece of it from my section, because there is a lot of Treasury debt coming to market over the next, call it 12 actually next couple of years, frankly. Right now, the maturity schedule for the U.S. Treasury Department is, I think, about 6 to 7 trillion of debt needs to be refinanced next year. Plus, there's an additional, call it 2 trillion of debt that needs to be issued to fill those budget deficits. So, I mean, you're looking at, 8 to 9 trillion dollars of Treasury debt that needs to find a home next year. Now, to be fair, a lot of that Treasury debt is in T-bills, these short maturity securities. So, as long as cash levels are elevated, that should be easily digestible by the market. But when you start to consider that this new Treasury Secretary may have to actually extend issuance, extend the maturity profile of the debt, that means potentially a lot more coupon issuance next year, which could keep rates elevated or even push interest rates a little bit higher. What
does that do to the corporate bond market?
Yeah, so the corporate bond market it's been an interesting year for corporate credit markets. If Treasury supply increases to the extent that we think it is, and it has the impact on Treasury yields as we expect it to, that means corporate borrowing rates are going to go higher as well. The spread between Treasuries and corporate debt level or corporate debt right now is pretty tight. So you can envision a scenario where those spread levels kind of stay at current levels or even tighten a little bit based upon just the amount of issuance coming to market on the Treasury side. The corporate credit market, I mean, it's expensive, but really it's in a good spot fundamentally. So we don't expect borrowing costs to increase significantly from current levels, but there will be some upward pressure on some of these corporate yields as well as a result of this increase in Treasury issuance next year.
I'm wondering about credit markets offshore, particularly China. We just had word relatively recently that Beijing is going to target a lot more when it comes to monetary easing to try to improve domestic consumption and a little bit of fiscal spending as well. Given what you're hearing coming out of Beijing, would you be tempted to play anything in the Chinese bond market?
Well, the Chinese bond market has been on a tear recently, right? I mean, we had Chinese yields that were inside, I think, Japan at one point on the 30-year tenor. So it's been a hot market for fixed income investors over there. I think, given the potential stimulus that was announced, we'll see if it gets enacted. But we'll see if they do in fact enact the stimulus that they've talked about today. I think that could actually make inflationary pressures pick up a little bit, both in China and perhaps globally. So I would stay away from things that are pretty interest rate sensitive globally at this point, just given the fact that we don't think the inflationary genie's back in the bottle just yet. And if China stimulus actually helps consumption grow in China, and particularly as it relates to the commodity complex, we could see higher commodity prices next year, which would flow into the inflationary prints, which is not a great thing for fixed income investors. I would stay away from anything with any sort of duration risk at this point.
So play things at the short end of the curve, right, to reduce that risk.
Absolutely. We're seeing a lot of attractive income opportunities in the front end of curves, not only in the U.S. but in non-U.S. ex-Japan markets, emerging markets. You can get a lot of income, and without taking on a lot of interest rate risk or even credit risk in some of these markets. So you don't have to take risk in the fixed income markets if you're not getting paid for it. So our advice is to stay within the belly and in terms of where to position money in fixed income.
Lawrence, thanks so much for joining us, helping us look ahead to the CPI print and talking more broadly about what's happening in bond markets. Lawrence Gillum is Chief Fixed Income Strategist at LPL Financial, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.